What if the next frontier of AI isn't just about smarter models, but where they're built? Elon Musk's XAI is reportedly finalizing plans for a 500 megawatt AI data center in Saudi Arabia, a facility so massive it could power 500,000 US homes. This isn't just expansion. It's a strategic pivot and a sign of how global AI competition is reshaping energy, geopolitics, and compute. Why Saudi Arabia? 3 reasons. First, energy abundance. The kingdom offers ultra-low-cost solar and natural gas, critical when training frontier models can burn $100 million in electricity alone. This abundance is crucial, as AI data centers are projected to double their global electricity consumption by 2030, consuming as much as a small city. Second, sovereign ambition. Saudi Vision 2030 prioritizes AI as a pillar of economic diversification, and XAI's deal likely includes local R&D partnerships and talent development, not just land and power. The Saudi Data and Artificial Intelligence Authority, SDA, aims to train 20,000 AI professionals by 2030, reflecting their commitment to human capital development. Third, compute sovereignty. By locating infrastructure outside U.S. regulatory reach, XAI gains flexibility in data governance, chip sourcing, and model deployment, especially as U.S. export controls tighten. The scale is staggering. A 500 megawatt site could house over 1 million Nvidia H100 equivalent GPUs, dwarfing even Meta's largest clusters. This capacity isn't just for Grok. 3. It signals XAI's ambition to train multimodal, reasoning-first models, possibly integrating real-time sensor data from Tesla, Starlink, and Neuralink down the line. But challenges loom. Extreme desert heat demands advanced cooling, likely using closed-loop liquid systems and waste heat repurposing, such as desalination. And talent remains a hurdle. Saudi Arabia is investing heavily in AI education, but attracting top ML engineers long-term requires more than salaries. It needs open research culture and academic freedom. The kingdom is actively building a talent-driven AI ecosystem through university partnerships and research projects, focusing on areas like healthcare and smart cities. This move isn't isolationist, it's multipolar. AI's future won't be built in one country, but across a network of energy-rich, strategically aligned hubs. If you're tracking how infrastructure, policy, and innovation converge in the AI race, hit subscribe, like, and share this video. Tap the bell icon for our latest on Innovation AI, where we go beyond headlines to the systems powering tomorrow. Because the next AI breakthrough won't just come from code. It'll come from watts, and where they're wired. What if the most important number in AI this quarter wasn't revenue, but forward guidance? Nvidia didn't just report strong earnings. It raised its next quarter outlook to an impressive $28 billion, plus or minus $1 billion. This confident signal sent the entire AI trade soaring 7% in a single day, demonstrating accelerating AI adoption, not a plateau. Nvidia reported record Q3 fiscal year 2026 revenue of $57 billion, a remarkable 62% year-over-year increase. This surge was largely propelled by its data center business, which achieved a record $51.2 billion in revenue, up 66% year-over-year. The escalating demand for AI training and inference infrastructure with the Blackwell Ultra platform played a pivotal role in this growth. The key detail is that demand isn't softening, it's deepening as enterprises move past pilots into full-stack deployment. This includes the establishment of AI factories, sovereign compute clouds, and internal inference clusters. Nvidia's backlog remains near $41 billion, meaning even with 0 new orders, the pipeline is full for 15 months. This isn't speculation, it's contractual commitment, underscoring the robust and sustained demand for Nvidia's technology. Equally telling is the strength in inference, which is now scaling deployment beyond initial training phases. While training drove the first wave, Blackwell Ultra adoption shows customers are now running real-time AI in production. This ranges from critical applications like fraud detection to groundbreaking advancements in drug discovery. Inference revenue grew threefold sequentially, clear proof that AI is moving from the lab to practical, real-world workflows. Geographically, The US remains core, but the Middle East and Asia Pacific are surging, fueled by national AI strategies and local data loss. One Gulf sovereign fund alone committed $6 billion to AI infrastructure in Q1, much of it Nvidia powered. And margins? They held firm at 78%, crushing fears of a price war, demonstrating Nvidia's strong market position. Why? Because when your platform controls the entire stack, chips, networking, software, and developer tools, you're not just selling silicon. You're selling time to market advantage, a critical factor for businesses in the rapidly evolving AI landscape. Wall Street gets it. AI isn't a cyclical tech bet anymore. It's a structural re-rating of global productivity. Nvidia is positioned as the toll booth on this highway, indispensable to the AI revolution. The broader AI ecosystem is expanding rapidly, with increasing adoption across industries. Nvidia is actively partnering with industry leaders like OpenAI, Google Cloud, Microsoft, and Oracle to bolster AI infrastructure. Analysts anticipate continued strong demand for AI processors, with Nvidia's future revenue visibility potentially reaching $500 billion by 2026. If you're tracking how signals like guidance reveal real-world momentum, hit subscribe, like, and share this video. Tap the bell icon for our latest on Innovation AI, where we cut through noise to the metrics that move markets and minds. Because in the AI era, the future isn't predicted. It's pre-ordered, and Nvidia just confirmed delivery is on schedule.
Nvidia's latest earnings call didn't just beat expectations. It redefined the timeline for AI adoption. Their quarter was structural, with $26 billion in revenue, up 262% year over year, and $14.2 billion in data center sales. A staggering $41 billion backlog proves AI demand isn't speculative. It's contractual, global, and accelerating. This isn't just about GPUs anymore. It's about full-stack dominance. Blackwell chip sales surged, and software and services revenue jumped 89%. Enterprises are locking into Nvidia's AI ecosystem, from CUDA to NVIDIA microservices. Cloud providers now account for only 45% of data center revenue, down from 70% in 2023, as sovereign AI funds and Fortune 500 companies drive the next wave. Margins held strong at 78%, defying fears of a price war. Nvidia isn't just selling chips, they're selling time to value, delaying AI deployment risks irrelevance, making premium pricing an ROI decision. While inventory levels rose slightly, this indicates aggressive forward builds, not softening demand. Most importantly, guidance for next quarter is $28 billion, plus or minus $1 billion. That's not hope, that's visibility. This isn't a bubble reaffirmed. It's a maturation signal. AI infrastructure is shifting from an optional upgrade to a core utility, like electricity in the 1920s. If you're tracking how capital flows reveal real-world AI adoption, hit subscribe, like, and share this video. Tap the bell icon for our latest on Innovation AI. Because in the AI era, earnings don't just report the past. They blueprint the future $1 billion at a time.
Meta just won its biggest antitrust case, and the market cheered. But beneath the rally lies a quiet warning. Winning in court doesn't mean winning in the future. The DOJ's case collapsed not because Meta's dominance is benign, but because regulators couldn't prove imminent harm under outdated statutes. That's a legal victory. It's not a strategic one. The core issue remains. Meta controls over 70% of US digital ad revenue, not through superior tech alone, but by owning the entire funnel: discovery, connection, messaging, and now AI infrastructure. Competitors can't access the data flywheel, and without scale, they can't train competitive models. Yet the ruling exposes a deeper risk: regulatory lag. Courts are playing chess with 20th century rules while Meta builds in 3D. The real threat isn't breakup, it's preemption. The EU's DMA is already forcing interoperability and third-party app stores. The US may follow with ex-ante rules, banning self-preferencing, mandating API access, or capping ad tech margins, long before another case goes to trial. For investors, the signal is clear. Platform risk is shifting from event-driven to structural. Meta's AI investments, $50 billion plus in CapEx this year, assume continued data advantage. But if new rules limit cross-app tracking or require data portability, that moat narrows fast. Smart money isn't celebrating. It's stress testing models. What if Meta's ad margins compress from 82% to 65% under DMA-style rules? What if Llama's advantage fades without WhatsApp-scale behavioral data? A courtroom win buys time, not immunity. If you're investing in the attention economy, hit subscribe, like, and share this video. Tap the bell icon for our latest on innovation, AI, and tech policy, where we separate legal headlines from strategic reality. Because in the platform era, winning the case doesn't mean you've won the war.
The AI supercycle isn't speculation, it's in the numbers. Global AI infrastructure investment soared from $42 billion in 2021 to $380 billion in 2024. This isn't a bubble, but a step function defining new eras, much like electrification or cloud computing. What makes this cycle unique is its self-reinforcing nature. More compute leads to better models, driving more enterprise use cases and revenue. Companies like Nvidia, TSMC, and Microsoft are seeing massive investments, accelerating AI adoption across every sector, from drug discovery to logistics. The bottleneck has shifted from technology to implementation, focusing on how fast and safely we can deploy AI. Hospitals are embedding AI in EHRs, manufacturers are wiring it into production lines, and governments are integrating it into procurement. This isn't pilot purgatory, it's scale. Application layer innovation will sustain this cycle for decades, even if foundation model progress slows. Capital isn't fleeing, it's redeploying from consumer AI to industrial applications, and from US only to sovereign AI stacks worldwide. This isn't FOMO, it's phony, fear of not investing. Super cycles aren't predicted, they're recognized early by those who read the infrastructure, not just the headlines.
What if the biggest threat to curing cancer isn't science, but spreadsheets? It now costs over $2.3 billion in 14 years to bring a single drug to market in the US, a system that's inefficient and selects against the most needed cures. High-risk science, like therapies for rare diseases, often can't justify the ROI, leading investors to chase me-too drugs. Clinical trials are a major choke point. Recruiting one patient takes over 6 months, and 85% of trials fail to meet enrollment goals. But here's the hope. AI is breaking this model. In silico medicine designed a novel fibrosis drug in just 18 months for $2.6 million, not $2 billion. Recursion Pharmaceuticals runs over 100 virtual trials in parallel, using cell imaging and AI to predict efficacy before human testing. The real bottleneck now isn't science, it's incentives. We need to decouple funding from blockbuster expectations to favor patients over profit. If you believe medicine should be measured in lives saved, not just shareholder returns, hit subscribe, like, and share this video.